Hey guys, welcome back to our channel, Pay Down Debt Solutions. And for some of you, welcome to our channel, Pay Down Debt Solutions. I'm Jen. And today I want to talk to you guys about debt to income. I want to talk to you guys about what you say to your bank matters. So it does matter what you say to your bank in terms of when you're trying to get one of our lines. Remember, always a line, never a loan. So on this channel, we teach a style of banking called velocity banking, and we teach it with the pay down method, the pay down way, the pay down strategy. And so the pay down strategy is a 3-step, very simple solution to your banking problems, okay? So there are many of you out there that find yourselves really payment strapped, okay? Really cash poor, really payment strapped. Maybe you don't have any cash flow. Maybe your debt to income is out of whack and you can't get a consolidation loan of any sort, or are told you can't get a consolidation loan. So I want to talk to you guys about this and about what you tell your bank and how it can make a difference in whether or not you are granted that loan or that line. So I have a really great student scenario too that I want to go over. These people are sitting in a really good position, and so glad that I got a chance to meet with them and talk with them. You guys, it's been a wonderful experience for us getting to meet some of you and getting to know some of you. And I'm so glad that we've made a difference in your life. And I'm so glad that we've, brought things in terms of, loans and lines and understanding how to run your banking a different way. Because traditional banking, running your finances the way that you're currently doing it today, gets you nowhere fast, right? And you know that because you're doing it today and you find yourself cash poor, you find yourself strapped, and you're in a position where you don't know where to turn necessarily because you feel the pinch of the day to day. Well, when you try velocity banking, you will find yourself in a whole other position, okay? Friends of mine that I know very well entered into some debt repayment programs, and it didn't do them any good. And so what I want to make sure you guys understand is that trying something different versus the traditional banking, okay, trying a different way to run your finances may make a difference in everything for you, okay? It may change your trajectory just like it did for Dan and I, all right? So we have some friends that entered into a debt repayment program, and it turned out to be one of the worst things they could have done. Again, these payment companies that come to you and tell you that they're going to consolidate all your debts, what they are is very predatory. And you guys, they're going to charge you 20%, if not 25%, to handle the debts that you could negotiate yourself, okay? And the other thing they don't tell you is that not all of your debt companies, okay, not all of these banks will work with them. So they present themselves in a way where they make you think that all of these companies are going to work with you, and they don't, okay? And so just like a friend of mine who that situation was hers, some of the debts were negotiated. There was another big debt out there that wasn't. So now she has 2 different payment buckets going on, which left her in the same position she was in, unfortunately, before. So I want to warn you guys against that. Try something different. Try velocity banking. There are different ways that you can run things, and that is what we teach on this channel. We can do it using nothing more than what you have currently. We can run scenarios for you, and we can make a change for you. And that's exactly what we did for these students behind us. We ran with exactly what they had, and then we also entered in a different scenario, or okay, so a different possibility for them. And I'm going to show you guys exactly that today. But first, what I want to say is what you say to the bank matters. So when you go to the bank and you're looking for a way to consolidate your debt, maybe you're looking at a personal line of credit, maybe you're looking at a home equity line of credit. And again, I want to make sure that I mention to you guys and reiterate this because I've said it before. When you go into a bank and you're looking at home equity lines of credit or home equity loans, okay, I don't advocate for loans, but that is exactly what they're going to try to push on you. Now, if you're looking for a personal line of credit, maybe you don't have equity in the home, maybe you don't have a home, maybe you're renters, right? So maybe there isn't an option for a home equity line of credit. That's okay. There's something called a personal line of credit. We can do all of this with a personal line of credit. As a matter of fact, we can do all of this with a credit card. You don't need either tool, but it does make it a lot easier if you can get a home equity line of credit, a business line of credit, or a personal line of credit. Those lines of credit make it easier because you can put all of your income into them and run all of your expenses out. With credit cards, it's a little bit more tricky because you can't put every expense into a credit card, okay? Such as loans, okay, if loan payments, line payments, such as credit cards, other credit cards. You can't put your mortgage, you can't pay your mortgage out of a credit card in most cases. You can't pay auto loans out of credit cards in most cases, but there are still ways we can work with you with those, okay? So anyway, so in this, in the scenario that I want to talk to you today, they were looking originally at doing a personal line of credit, and they have a credit union that offers up to $40,000 for a line of credit, which is phenomenal. Now, when you walk into your bank, they're probably going to try to steer you to the loan, okay? And that's what they do, you guys. I was a banker, I was a branch manager, I know what I'm talking about. So they're going to steer you that way. Number one, because they think they're doing things for you, right? They're looking out for your best interest because they're trying to steer you to the product that's going to give you the lowest interest rate. But what they don't understand is how we run with Velocity Banking. And the other thing is, if you guys go and try to tell them you're running things through Velocity Banking, you're going to get the deer in the headlights look, and they're going to blink at you, and they're going to think, these people are nuts. We're not going to give them a loan at all or a line of credit, right? So you might not want to even talk about that because you guys, they don't understand it. They don't know how this works, okay? So, and I don't want you to say the wrong thing, right? About what you say matters. So I don't want you to say the wrong thing either. And we're not doing anything wrong. What we're doing is perfectly legal. There's nothing wrong with it. But the banks don't understand that. And things they don't understand, they tend to steer clear of, right? As all things in life, right? If you don't understand something, you're very hesitant about it. Banks are the same way. So something they don't understand, they're hesitant about. So we say things that they're used to, okay? So when you approach a bank, and so again, when I was talking about this student scenario, they did talk to their bank about getting a personal line of credit. And they were declined that, okay? Now, not based on credit score, okay? And their credit scores are okay. They're not great, but they're okay. So we're looking at, they have an actual 640 and a 660, all right? So they're not terrible scores. A little bit of work, just a little bit of work, and it has them right at 700. So that's really encouraging. But the problem is this. They were told that their debt to income is out of whack and that they can't get a personal line of credit such as the one they wanted due to their debt to income. Now, I didn't have the explicit conversation with them about how they approached the bank on that line of credit, but I do want to mention this because it's very valid and it's a very good point, and I thought about it later. So these students, they know who they are, and I'm going to let them know about this video too, but let's talk about it, and let's talk about what you say to the bank when you're approaching them about doing something, okay? Doing something for yourself to help you get out of debt. And you can. Running Velocity Banking, you can do it much faster. Now, what you say matters. So number one, I want you guys to be educated about what you say, okay? That is very, very important because banks will ask, what is the purpose of obtaining this loan or line of credit? They're going to ask you that, okay? If the purpose of getting a home equity line of credit or a personal line of credit is to consolidate debt, then say it. Because when you consolidate those debts, okay, you are going to lower your DTI. That's naturally going to happen because DTI is based on payments, okay? And when you consolidate your payments, right, into a line of credit, that's actually going to eliminate some for you and make it one payment versus, 15 or 6 or whatever you have going on. Now, this becomes important because I don't want you guys to say something like, oh, it's for a purchase or for home improvements when it's not, when it's for consolidating debt. And obviously your debt to income is probably out of compliance, right? So you don't want to say something like a purchase or home improvements if that's not what it's for, okay? Because then they're going to look at you and say, well, you can't, your debt to income's out of whack. And they're not even going to say, okay, well, if you're looking to consolidate debt, let's take a look at this. If we eliminate this payment, this payment, this payment, and this payment by consolidating it into that home equity line or into that personal line, then they're going to rerun your debt to income and they will see if it's dropped enough to put it in compliance, okay? So it's really important that you say that to them, okay? You don't want to say too much, but you don't want to say too little, and you don't want to say the wrong thing. So that's what I'm talking to you guys about this today. So in my student example here, if their income is $6,300 and their total expenses are $5,372, okay? Their loan and line payments together are $3,198, okay? So remember, debt to income is based on your gross income and your payments, not the total debts you have out there, but the payments themselves, okay? And it's just line payments and loan payments. It's not your living expenses, okay? That's how they calculate your debt to income ratio, all right? So if their loan and line payments are $31.98 and their gross income, let's say their gross income is $6,900, okay? Just for shits and giggles, we're gonna say it's $6,900, all right? So that would mean that the loan line payments are $31.98 divided by the gross income, which we've said is $6,900, okay? That means their debt to income is $31.98 divided by $6,900. And then you're going to multiply that by 100 to give you 46%, okay? And 46% is out of compliance for a conventional loan in most cases, okay? So now, there are some that will work with you at that, but most often they want to see that 45 or less, okay? And so this would be then out of compliance, right? That's why they might have come back and said, it doesn't work. So no, your DTI is too high. But now, and there's other things going on here too. So if they could get a personal line of credit for $40,000, but yet they couldn't eliminate enough debt payments to drop them below what that credit union looked at, that would be another reason why, even though maybe they knew that, right? That would be another reason why they couldn't do this. So it all depends on kind of what you're trying to do, but you guys can work your numbers. So if you know what your gross income is and you know what your payments total, okay, you can kind of figure out what your debt to income ratio is. And then you can call the banks and you can say, okay, here's what I'm trying to do. Here's what my debt to income ratio is. Does that put me in line with any of the products that you have out there, okay? And that's another way you can approach it. So you don't have to have that hit on your score, right? You can actually just have a conversation, get an idea, and they're going to tell you at that point whether or not it makes sense to come in and check it out, okay? So they could do that. So that's kind of how you want to approach this, all right? So you do want to tell the banks what you're looking to do if it is debt consolidation, because that's going to change their look and their outlook for you, because they will run the numbers that way for you at that point, okay? So let's look at the student scenario that we had just the other day, okay? Love these people. They were really awesome people. Again, you guys, Dan and I just love this. We love doing this for you guys. We love meeting all of you. We learned so much about you, and we learned just so much about people in general and the different people out there. We just have a blast with it. So, if you guys feel like you want some extra help or extra coaching, we do that for you. Not that you need it, because you guys can do this on your own. My job is to equip you with that with these videos. I want you to be able to do this on your own. And that's why we keep turning these out, so that you guys can handle it on your own through watching the videos, okay? So if you want a home equity line of credit, okay, and you want it for debt consolidation, then say it. Tell them that, right? Okay, so in this scenario here, all right, so they weren't able to get a line of credit based on, or a $40,000 line of credit based on their DTI, okay? So there are some other things that they can do. Now, these guys in particular are in Texas. And so Texas does have some specific rules about home equity lines of credit, all right? They will allow 80% loan to value, okay? So that being said, that 80% loan to value, it doesn't matter if it's a first lien or second lien. So for example, for us in Michigan here, so 80% loan to value for the second lien. The first lien, they'll let it go all the way up to 90% loan to value, and many other states run it that way as well. Texas, however, does not. They also have a minimum amount that you can get. So you can get a minimum of $20,000. So sometimes that kicks it out for some people, okay? So the minimum is $20,000, and then you can only go up to 80% loan to value, all right? So in this case, for these students of ours, we had a discussion about their home value and what their current mortgage balance was, and we determined that they actually do have a considerable amount of equity. So this is an option for them, okay? However, we did run their scenario based on exactly what they have going on here, which is, lines and loans, okay? So they had lines and loans. We ran it straight on that in case they couldn't get anything else. And that's what we always like to do for you guys, just like I want you guys to do that for yourself. So when you're looking at your plan, I want you to consider what you have right in front of you first, what you have to work with right there, and work with that and see if you can make something work. Then you're going to move on to the next step, and that is, okay, I can do it with the credit cards that I have. Now, what might other options be for me? And this is the other option that it might be for them, okay? So same thing, I want you guys running it just like that. First, take what's in front of you, run it that way, okay? Run scenarios that way for yourself, and then look at the potentials, okay? Because number one, you might be able to get that potential right away. But if not, that's okay, because now you have a goal that you're working towards just by running the scenario as you worked out for yourself using just what you have. Because when you run velocity banking, you are going to increase your credit score for one, okay? That's naturally going to happen. And maybe you don't have equity in the home, but maybe then you could qualify for a line of credit that will get you where you can put all of your income in, all of your expenses out, right? Rather than holding back things that you have to, hold back in your checking account and pay, kind of with cash, because you can't pay it through any of these tools, okay? So the tools that we love are the loans. I'm sorry, not loans at all. I hate loans. Are the lines of credit and the home equity lines of credit and the personal lines of credit, because you can run all of your income into it and all of your expenses out via your checking account, right? Because we know that when you have a line of credit, okay, those funds go into your checking account to pay for your expenses, okay? So the money moves from the line of credit into the checking, from the checking to pay your bills, okay? So it's like a sweep, okay, in and out. Now, you want to make sure that can happen naturally, but if it doesn't, you just have to move the money manually, which again, you guys, we're in a digital age. It's a click of a button on the computer. You just move money over, cover your expenses, okay? So that's how easy it is to run it that way. All right, so for these guys, we ran it again. Dan did an awesome job running their numbers for them. Like I said, we had a blast, but we ran what they had first. And then when we had a meeting with them, we sit down and we say, okay, this is how we ran it, but what other options do we have and what other opportunity is out there? And then, of course, I look into the state that you guys are in too, just as you're going to look into your state and find out what the requirements are. All right. So here is their scenario. Okay. So we have a net income, all right, which is $6,300. All right. That is net. And their total expenses then are $5,372, which means these guys actually do have a cash flow, but it does feel tight, right? Because when you're running expenses like this, that gets to be pretty tight no matter what, all right? So they want to be out of these debts, and I don't blame them. Just as Dan and I, we wanted to be out of our debts too, right? So their cash flow is actually $928. This is what they have going on. They have venture at that with a balance of $9,254, and that is $310. They have a Capital One card at $7,764 at $243. They have Citi at $67.96 for $241 payment. Then they have Chase for $23,018. That's an $808 payment. They have a Discover Black at $87.11 for $285. They have a Discover Gold at $9,064 at $182. They have another Discover at $15,120 at $347 is their payment. They have a C1V1 at $5,733 for $230 a month. And then they have an AACU for $17,749. And these, you guys, this one was at the lowest interest rate. I think it was 5.4. I forgot to write my interest rates down there, but they were all high. Their interest rates were all, because they're pretty close to the limits on all of this, right? They are. We're looking at 29%, for 27%. I think they had a 24% in there. They had one at 20%, but the rest were really high. Okay, so these were high interest rates. All right. So when they looked at their traditional banking, okay, so they ran it traditional banking, and it was going to take them 110 months. Okay, so that means it would take them 8.4 years to run all of this debt. Now, their total debts equaled $94,498, and those debt payments were again the $31.98. And to run it traditionally, 10 months, 8.4 years. Now, when they came to us and we did a coaching plan for them, okay, and we ran it based on the numbers that they had. We got them down to 35 months, which is 2.9 years, okay? So we got them down considerably. Now, let me show you what that brought them, okay? So if we look at this, the traditional banking plan, and this was a killer. When we talked to them, they didn't even realize how much money they would be spending. Again, you guys aren't feeling it, right? You're not really feeling this dollar amount. You feel it every day because things feel stressed and they feel cramped and they feel tight, right? But you don't actually understand those numbers until you see them. And seeing that you're going to spend $62,000, okay, on debts where you have $94,000 out there. That's more than half of this, right? So that's a ridiculous amount of money to pay. And that is why we don't do traditional banking. That is why I'm teaching you guys to run things through a velocity banking using the pay down method, okay? So 101 months and 8.4 years. Now, when we ran it for them, or I should say Dan, because Dan ran this one for them, he got them down to 35 months at 2.9 years. And that means they spent $35,881 in interest, or they will spend that. That is a little tiny bit more than half of this, right? I mean, look at that. That's a considerable savings, right? And $35,000 is a lot of money, but it is a heck of a lot less than what they would be doing through the traditional banking way. Not only that, look at the time they've saved. And you guys know this. Time is money, right? So you're wasting 8.4 years when you can do it in just under 3 years. And the rest of the money from getting rid of these debts is all now in your pocket as cash flow. Think about what you can do with that money, where you can save it, or what you could buy with that if you wanted to buy something. You guys think about that, because again, absolutely 100% time is money. And so this means more money in their pocket longer over time, okay? All right, so then we took a look at what they had going on in their state, okay? Knowing that their score is a 640 and a 660, okay? Now, Texas is a state that will allow home equity lines of credit with a 620. Now, the rate you're going to get at a 620 isn't going to be the best rate you could get for a home equity line of credit. Now, is it? It's not going to be, because we know that your credit score also dictates the percentage, the interest rate that you're going to get. So I ran this on a high, okay? Yes, this is a hypothetical because they haven't done this yet, but it's something they're definitely going to look into. Okay, so they're 80% loan to value. That means they can go to 293,120. Their mortgage balance is $124,061. And that means that their total, okay, is 169,059 that they can go up to, right? Because they have to subtract that mortgage balance off. So they can go up to about 169,000. So if they get a home equity line of credit for 160,000, and if we run it at a high of 15%, which is what I'm going to do, okay? And we know that's high. That's probably not what it's going to be, but we're going to run it that way. So that means we're going to take the 94,498. We're going to then run our income through it, right? Remember, income in and your expenses out. So my income is $6,300 a month. So it drops our balance, right? So we go from 94,498. We bring in that income and it drops our balance immediately to $88,189. So why do we do that? Why? You guys know. So when you bring in your income like this, okay, these lines of credit are calculated on an average daily balance. When you immediately drop your balance like that, that means your effective interest rate is going to be less, right? Because it's done at an average daily balance. That means you're only at this high for about a minute. Your income comes in and it drops it to the 88,189. And then your expenses slowly throughout the month come back in, okay, and build it back up. But it's never going to reach this if you're running it the right way, right? It's never going to reach that again. It's going to continuously be lower. So in order to figure out what this interest rate is for us monthly, or this interest payment monthly, I should say, we know the interest rate is 15%, but the payment, okay, how do we calculate that? Well, we're going to do it this way. So we take, let me find a calculator. So we're going to take, okay, we're going to take our high balance and we're going to add it to our low balance. So we're going to take the 94,498, we're going to add it to 88,189. That's going to equal 182,687. We are going to then divide that by 2 to get our average, okay? So that gives us an average, and that's 91,343. And then we are going to multiply that by 0.15, right? Because we have to turn our percentage into a decimal. Then that equals 13,701. That is for a year's worth of interest at that average, which was 91, right? At that average. But we don't want a year's worth. We only want 1 month because we know it's going to drop every month. So then we divide that by 12, and that gives us 1141, okay, which is 1141. So each month we know that's going to drop, okay, unless we have a month where we have something happen and our expenses go up, right? This number should come down, all right, every month. Our expenses will remain the same. Now, how did I get those expenses? How? Well, I said that the expenses were $31.98, right? That's what these loan payments were, all right? So we subtract actually the $31.98 from the $53.72 because those are gone. We paid them off using this line of credit, right? So that's where I'm getting the rest of their expenses being $2,174, okay? Mortgage payment in there, some other things, right? So you run this down, right? So we have our expenses come back in every month. We have our interest come back in every month. So our real balance then at the end ends up with $91,513. Remember, that's pretty close to the average now. So we have our high balance, we have our low balance. We start out with $91.53, so it's come back up to that. So remember, you start at 94. What's our check? What are our checks? We start with $94,498. After our expenses and interest come in, are we higher or lower than this? We are lower than this, so we are going in the right direction. Thumbs up on that, right? Same thing again, next month, income comes in, $6,300. It drops our balance to $85,213. Our expenses come back in and our interest comes back in. And look at how our interest is lower. See how that works? Okay. So again, 88, dropping it to 85. After the expenses and interest come in, we're at 88,491. Are we lower or higher than this? Again, we are lower. So we're going again in the right direction. So what does all this mean at the end of the day for these guys? Okay. If they take a home equity line of credit at 15%, which would be, that would be high, really high. So let's take a look. Okay. So I ran it for you at 15%, and I also ran it for you at 12%, which would be more normal. Okay, that would be the norm. So if I take this down and we show what they then have the possibility of paying, this is why we Velocity Bank right here. It's going to take them at 15%, okay, interest rate, 26 months, and it will cost them $16,243. Time is money. Time is money. Time again is money, all right? Now, they're probably going to be closer to 12%, okay? Maybe even less than that because prime is lower than that even. But depending on their credit score, depending on what happens, right, what goes on, that means they could get, if they get a 12% home equity line of credit, that means they will save 2 more months. Oh, I'm sorry, 1 more month. And they will save about $4,000, right? So $12,404, okay? So again, this is why we do Velocity Banking. Now, worst case scenario, they can't get this yet, right? If they can't get the home equity line of credit yet, that's okay because we have a plan and we talk to them about their plan. They know that they have steps that they're going to take. So in 10 months, they will revisit, okay, and look at doing a line of credit, okay? They will do that in 10 months because by then they're going to have paid some other things down to a level where they could probably get this and their credit scores will be higher, okay? So if they can't do this tomorrow, that's okay. We have a plan in place, and that's why I want you guys to run your numbers first as is, and then set your plan if you need to, right, going forward. If you can't do it now, you'll do it later. So in any event, these guys are going to save a boatload of money by running things through Velocity Banking. You guys, I hope you subscribe. We just want to get the word out. We want to get the word out to as many people as possible. There is a way to bank that will save you time, that will save you money. And we know that time is money, and that is important to me, and I know it's important to you. Have a great day, you guys, and we will see you in the next video.